Hi, I am CA Pritish, and in today's video we are going to discuss what happened to the stock markets yesterday and how stock markets fiercely react to an interest price hike. Always we have been hearing that a US Fed rate hike is causing the volatility in the US markets as well as the Indian markets. So as stock market investors or as prudent investors, we ought to know what happens when there is an interest rate hike. So this is basic economics that we need to understand, and not only that, how the rate change in the repo rate or change in the rate by the RBI affects your pockets, that is any EMIs that you're planning to take or already have taken. First of all, we need to understand the importance of RBI's monetary policy. In an unexpected move, the Reserve Bank's governor comes and says that there is going to be an interest rate hike, the repo rate hike by 40 basis points, and the stock markets fell down drastically by 1500 Sensex points. And in that case, what really happens is that the stock market doesn't like any surprise move that is taken by the RBI or any event that is taken by surprise. So that is why the stock market fell very fiercely. The main concern here with the Reserve Bank governor is that there is inflation which is beyond control, and that is why they had to hike the interest rate. So is this the last interest rate that is going to hike that is going to have taken place? The answer is absolutely no. You should be prepared for more interest rate hikes because the inflation is beyond control. First, let us understand what is inflation. Inflation in simple terms, it is nothing but price rise. Say for example, in the previous month you had bought onions for 10 rupees per kilo, and in this month it is 15 rupees per kilo. So what is the inflation? It is increase in the price of onions by 50%. So the RBI has no option but to increase the interest rates. It should have been done earlier in tranches, but they chose not to do it, and suddenly they come out with a policy measure saying that we are going to hike the interest rates in an unexpected move. So in that case, it is important that the RBI has some data which clearly suggests that the inflation is going beyond control and they had to act very quickly. So when it comes to returns, I always suggest you that you should be looking at inflation adjusted returns. Say for example, your interest on investment is giving a return of 6%, whereas inflation is 7%. That is, you are going under a negative return. That is called the real return. So real return is nothing but the inflation adjusted returns. So always be careful to take this factor into account. Now, from where do you get this inflation data? Month on month, the government releases the consumer price index and also the wholesale price index, which determines the inflation rates. So what is alarming here is that the wholesale price index, which considers the wholesale price of the goods, was high as 14.8% in the month of March 2022, whereas in the previous year around the same time it was just 7.8%. So it has doubled. Also the consumer price index, which considers into account the food prices and also the services that are availed by the consumers, was as high as 7%. So that is really alarming, and that is why the RBI had to act quickly on the inflation data. Now, what are the reasons for this inflation? The first reason and the most important reason is that there is a war that is happening in Russia and Ukraine, which has disrupted the entire supply chain, and also there is a price hike in the crude oil prices, the natural gas, the mineral oils, and there is of course shortage of edible oil, and because of this there is an increase in all the prices which has led to this inflation. Always there is a big hue and cry when it comes to the interest rate change by the Reserve Bank or the Fed rates in the US. So what really happens? How does the stock markets affects because of this, and how does it affect your pockets is what we need to look into. The first thing is that whenever there is a growing economy or whenever there is a high demand or whenever there is an inflation, the Reserve Bank or the central bank of any country puts the brake on the demand and also on the economy by hiking the interest rates. How does the central bank or the Reserve Bank act on the inflationary pressure? The first step or the monetary policy that they take is that they hike the repo rate. Repo rate is nothing but the rate at which the commercial banks borrow from the Reserve Bank of India. Whenever there is a hike in the repo rate, they obviously have to pass it on to the consumers, the commercial banks, because they borrow at higher rate from the Reserve Bank of India. And at the same time, your EMIs, your personal loans, your car loans, your home loans are definitely going to be impacted. So if there is a 1% increase in the repo rate, definitely it is going to get passed on to the consumers or the home buyers or the personal loan availers. So in case if you are buying the home loan at 6.5%, your home loan is going to get increased by the 40 basis points, or if it is a 1% increase, then it is going to go to 7.5%. So ultimately the burden comes on us. So what happens when there is a repo rate increase? How does it tackle inflation? So it is basically putting a brake on the economy. Whenever there is an upward trend in the economy, whenever there is a high demand, so it is just putting a brake by increasing the rates. So whenever there is a increase in the rates, what happens is that the borrowings becomes very expensive, so that there is a control on the demand. Borrowing becomes expensive for you and me, and also for the corporates or companies, so that there is no more investments and there is no funds at a cheaper cost available. So the general tendency is that when the home loans become expensive or any loans become expensive, you simply postpone your buying of a home, or what you do is you reduce the amount of loan that you're going to take, so that the burden on your pocket becomes lesser. So this is where the demand is reduced for various goods, and that is how the control on inflation is done by increasing the interest rates. A very important aspect that the RBI or the central bank takes care is not to increase the interest rates all of a sudden, because what happens is that the corporations or the companies may stop hiring or even lay off the employees, and because of that there could be unemployment and disastrous effects on the economy. So they increase the interest rate stepwise. So now why does the stock market react so fiercely whenever there is an interest rate hike? The public and the private companies that are listed in the stock markets, or any company, what really happens is that the commercial borrowings becomes more expensive, and in that case the cost of doing business also becomes expensive, and also there is less demand for their products or their goods, because the most important aspect to increase the rate is to bring the demand down to cut the inflation pressure. So that is where the less business is taken into account, and the cost of borrowing is also more, and that affects your profitability. So that is where your stock prices also can get affected. That is one reason. And the second reason is that the traders quickly sell off in panic mode, because they come out of the stock market and they opt for better investments which give you a fixed return or a better return. The RBI in 2019 cut the repo rate by 250 basis points, that is 2.5% in the year 2019. So in order to bring the cash flow into the economy, and people borrow, because people borrow and there is a demand created for more products, home loans and all of that, so that there is a revival in the economy because of COVID-19. Thus, Reserve Bank has also increased the cash reserve ratio. That is, the commercial banks have to maintain an amount of deposit with the Reserve Bank, that is the statutory reserve. So in that case, when there is a reserve that is increased, an amount has to be kept with the Reserve Bank, and in that case the availability of funds with the commercial banks to give loans or more loans is reduced. So in that case there is no liquidity in the market, and that is why the borrowings becomes extremely difficult, and because of that there has been an 87,000 crore less liquidity in the markets. Now we were looking only at the negative part, so let us look at the positive part, especially for senior citizens who rely only on fixed deposits. So whether your fixed deposits are also, interest rates are also going to get increased, the answer is yes. Whenever there is an interest rate hike, the borrowings also become expensive, and also the interest rate on your fixed deposits and other deposits also are going to increase, because from a very long time the fixed rate interest were at a very low pace, but now that is going to change gradually. So friends, it is very important that you take an informed decision whenever you're investing in the stock market, or it is better that you hold your investments for some time and then invest in a phased or a staggered manner, because the times that are going to be ahead are very difficult, because the economic scenario globally doesn't look so bright. So it is very important that you take a cautious stand and then invest in a phased manner. Thank you very much for watching this video. If you have liked this video, please like it, comment and subscribe my channel. Thank you very much.